David Johnston from Property Planning Australia is very passionate about the financial and lifestyle benefits that the correct adoption of an offset account can actually bring. He sets that out in this interview with Cate, and they also touch on stepping stone properties and how first-time investors can use this with the proper plan. Here are David and Cate.
Hi Dave. Well, once we chatted about offset accounts on our podcast, and I thought it would be a great one to chat to you about today. So what I wanted to quiz you about was the difference between offset and redraw.
Sounds good, Cate. Look, it's a common misconception that offset and redraw are the same thing, but they're certainly not. The best way to think about it is an offset account is a credit account. So it's a totally separate bank account to your loan. And to demystify a loan, you need to think of it as just another bank account, but unfortunately it's in debit rather than credit. And so what redraw is every dollar over and above your set repayment that you make, that is how far you are ahead on your additional repayments. And for most loans, particularly variable rate loans, every dollar you're ahead on your minimum repayment will become redraw, which means you can access that money through your loan. However, that's very different to having money in a savings account, which is ostensibly what an offset account is, but it reduces the interest payable on the mortgage in exactly the same way as a repayment would. So that's a really important delineation to make, because that separation between an offset account and actual redraw can set you up for a whole range of mortgage strategies, such as optimizing your tax deductions, your ability to keep a home and turn it into an investment property when you upgrade, your ability to have multiple offset accounts that drive your money management system, and your ability to build up a huge buffer to manage risk. And so that separation is vital.
We can chat about this for hours. There are that many benefits to offset, and unfortunately a lot of people get it wrong. They look at the cost of an offset account, which is tiny in comparison to the benefit. But what I would like you to explain, if you can, is the mechanics of the tax deduction for offset and why it isn't relevant for redraw.
Yeah, so basically, once any money that's in a debit account, which a loan obviously is, that can be claimed, the interest on it can be claimed as a deduction if the purpose the money was spent on was for an investment. But as soon as you make a repayment, you can never get that balance back, if you like, and therefore that potential for the deduction. So as soon as you pay it down, that deduction's gone. So what an offset can do is enable you to preserve future tax deductions. And that means your balance stays at the same level, but your offset account's building up, so you're reducing the interest payable. But then if you want to put that money towards something else, and it might be a future home, for example, and you haven't paid down the loan, well, you've preserved your tax deductions. And that might be the difference of an extra $5,000 or $10,000 in tax deductions per annum. But if you're able to keep that property for another 30 years, I mean, that can add up to hundreds of thousands of dollars in tax deductions, and your ability to keep that asset, which might put an extra $1 million into your retirement.
It's a great point. It leads me into my next question, actually, Dave. A lot of young buyers obviously look to purchase a home that they know is not their forever home. And we call it their stepping stone home. Now, if you get it wrong and you've bought a stepping stone home and you've got a redraw account that you're using and you haven't taken on the offset product, then you're unraveling your benefit. Can you talk me through that, the redraw that versus offset for a stepping stone?
Yeah, look, essentially, if they're paying down their loan, as we've sort of touched on, they're therefore going to have a lower loan balance. So let's say the first home, they purchased it for $600,000, borrowed round numbers $500,000. If they're paying that loan down, which we're all taught to do, and it's a great idea, obviously we all want to reduce our mortgages and interest, but if they pay that down to $300,000, and then turn it into an investment property, they're only going to have tax deductions on $300,000. Whereas
and that's because the ATO writes the rules here. They will not recognise a loan that's been paid down.
100%. So that would fail the ATO purpose test. And a lot of people have the misconception you can then just redraw that $200,000 out, put it towards a future home and claim it as a deduction, the $500,000, but you can't, because that $200,000 has gone towards the future home. Whereas if that $200,000 was an offset account, totally separate account, credit account, that then can go towards the future home, and you've still got the deductions on the $500,000.
Fantastic point. Now, for people who are looking at building up their portfolio and utilising their offset account to do so, talk to us about the purpose test.
Yeah, so the purpose test essentially is once you purchase an asset, first and foremost, you can only claim interest on the money that was borrowed to pay for that asset. So it's a bit, I guess, counterintuitive, but there actually is an incentive to borrow the optimal amount that's going to optimize your long-term future tax deductions. So every dollar you pay down from then on, you can't get that back. You can't redraw it and then claim it as a deduction. Otherwise, that's where you fall foul of the ATO purpose test. And that's why the offset account is so critical to these this mortgage strategy or strategies that we're talking about.
I love this topic, and it always shines light on why it's so important to talk to someone about having a great plan. They have to be all across the detail and have a deep understanding of tax deductibility when it comes to lending products. Dave, thanks for joining us. It's been great.
Always a pleasure, Kate.